Hello, this is Andrew from Cloud Learning. Today's book is One Up on Wall Street by Peter Lynch. If you like my work, please like it, subscribe to this channel, check the playlists, and support me on Patreon and PayPal. The links to Patreon and PayPal are included in the description to this video. First, I'll describe the contents of the book, talk about what's interesting about it, then I'll move on to what you can get out of this book. Peter Lynch is an American investor, mutual fund manager, and philanthropist. His most famous role was as the manager of the legendary Magellan Fund of Fidelity Investments from 1977 to 1990, where he averaged a 29% return. This was consistently more than double the return of the S&P 500 stock market index. This made Magellan the best performing mutual fund in the world, with its peak size at $14 billion. Lynch was a promoter of value and growth investing of stocks. In 1989, he published One Up on Wall Street, one of the most popular investing books of all time, and recommended reading in universities and in finance. It is frequently read by beginners and has sold over 1 million copies. One Up on Wall Street popularized and promoted the stock investment strategy GARP. This stands for growth at a reasonable price. This is a hybrid stock picking approach that balances growth investing potential for share price increases with the discipline of value investing to avoid buying overpriced stocks. The main goal of this strategy is to find stocks Lynch called 10 baggers. This refers to an investment that is worth 10 times its original purchase price. This strategy is followed by many investment funds. The chapters of this book focus on telling the average investor how they can find 10 baggers by using what we know and our own local specialized knowledge. According to Lynch, investment opportunities are everywhere. From the supermarket to the workplace, we can encounter products and services all day long. By paying attention to the best ones, we can find companies to invest in before the professional analysts discover them. Then Lynch offers easy-to-follow advice by analyzing the quality of stocks, by reviewing a company's financial statements, and finding the numbers that matter. He also offers guidelines for investing in various types of companies, whether they're cyclical, turnaround, and fast-growing. Although the book is old, the fundamentals of stock picking has not changed. Mass human psychology and the markets, which are driven by it, don't change very much. The central message that one does not need to be a professional or even listen to the pros to be successful in the market appeals to the common people, but should be regarded with caution. For the individual investor, odds can be in your favor if you invest in what you deeply understand. So if you work in a certain industry, your knowledge can be used to invest in stocks of your industry. Or you can simply find the goods and services in your daily life and see if the companies that provide this are worth investing in. An example he gives is how he invested in Dunkin' Donuts, not because he read about it in the Wall Street Journal, but because he was a customer and found the business to be outstanding at the time. Ultimately, for Peter Lynch, he found his college education in philosophy and logic more useful in his stock picking than his MBA studies. So the investor thinks like a business person. They can have an edge on the pros. The problem with professional fund managers is that they have many restrictions and limits from their clients and the government. This makes it harder for them to maximize their gains. On the other hand, the individual investor can potentially identify unknown and hidden winners before the stock gets media coverage and becomes well known. Once it's well known, it's overpriced. So GARP, growth at a reasonable price, is important to have a good understanding of the business of the company that you want to invest in. Lynch advocates investing in pantyhose rather than communication satellites, or in motel chains rather than fiber optics. The simpler the business, the easier it is for the individual investor, because those companies are easier to run and follow. Lynch thinks it's better to invest in the mundane and lower risk than invest in the flashy and the risky. Some of the desirable characteristics is that the business is boring, seemingly silly or inconsequential on the surface, or has something depressing about it. If that's the case, the chances are that many investors and stock analysts aren't following it. Other attractive traits are that stock is a spin-off, institutional investors don't own it, analysts don't own it, or the stock has a niche, or the insider investors are buyers. Lynch advocates that investors avoid stocks that are the hottest in the hottest industry or touted as the next big thing. They usually don't pan out and are overpriced. Companies should be classified in one of the following 6 general categories: slow growers, stalwarts, fast growers, cyclical, asset plays, and turnaround. It would not only allow you to set your expectations, but also help you to make decisions along the way by benchmarking other companies in the same category. The second step after picking a company is to check the company fundamentals, such as earnings, cash flow, and fact-checking the story. He also described in detail how to get the most out of the company's annual reports. There are basics in stock valuation and analyzing earnings, cash flow, and other data. If investors are successful, they will eventually find a stock with extreme returns, a 10-bagger or better. Lynch advises that we invest for the long term and for growth at a reasonable price. He thinks that 10-baggers can take 3 to over 10 years to play out. Besides this, Lynch disfavors market timing and paying too much attention to the general economy. He considers most of the effort a waste of time for stock pickers. However, he believes in the adage that we should be greedy when people are fearful. So when the stock market crashes, there are a lot of bargains to buy. One Up on Wall Street was one of the first investing books I read, and I was introduced to it in college as a finance major. Since then, I've worked in finance and have read many books on investing, in particular value investing. The book lists are compiled on Goodreads, and the link is available in the description box to this video. There are many books on value and growth stock investing. They are more advanced in detail than One Up on Wall Street. But for the beginner, this short and easy to read book by a master serves as a quick bridge to greater understanding and more advanced material. I would not read this book alone, but as a prep guide to superior books like Professor Greenwald's Value Investing, From Graham to Buffett and Beyond. And most definitely read this before you even attempt a stock valuation book. I recommend this book as a quick read despite how dated it is. Readers should be wary that the examples are very dated and some of the advice is out of date. Times have changed a lot since the 1980s and 1990s. This is a time period where a lot of the old stock picking examples are taken from. So some of the content should be taken with a grain of salt and critically appraised if this is too old and irrelevant. Readers should also beware of getting too cocky after reading this book. Peter Lynch's success was not just due to his talent, but also his vast resources of fidelity. He spent all his days researching stocks and following the markets. He also had a large team of people to help him achieve his greatest success. Individual investors and with other careers don't have all these resources of information, free time, and investing genius. They should not expect that their own stock picking results will be as good as the masters. All in all, this book is solid, but it isn't great. It is a beginner's book. This book should be used to get your feet wet and definitely shouldn't be read by itself or treated as a Bible. After you read this, I recommend reading Value Investing, From Graham to Buffett and Beyond by Professor Bruce Greenwald, and the Shareholder letters of Warren Buffett. I rate One Up on Wall Street a 3.5 out of 5. So that's what I think about One Up on Wall Street. Please put your thoughts and ideas in the comment section. They always make a great conversation. I hope you find my review to informative. Thanks for watching.